We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Rick Rule, investor, speculator, and founder and CEO of Rule Investment Media. Rick, it's always a pleasure to have you. How are you?
My pleasure, Tom. Thank you for allowing me back on. I enjoy these conversations.
As do I. And you do provide a lot of value, and I think especially wisdom through these conversations and over our time speaking together. But I want to back out a little bit and kind of understand your perspective right now through, let's say, past all the noise that we're currently experiencing. There's never a dull moment in, especially this administration, this time with all of the news flow. So what is, let's say, worthy of your time and attention to understand what's going on right now?
Well, worthy of my time and attention. I'm 72 years of age. I don't want my tombstone to say he was a jerk. So I'm trying to do the best I can with what I have to improve my community, improve my businesses, look after my employees, look after my customers. It's interesting, the context of the question you just presented. I've said on your show before that I think that we came through really a 40-year epoch, 1982 to 2022, that were the most benign, gentlest epoch for investors in human history. But I think that's over. I'm not saying the world's going to go to hell in a handbasket, but it's going to be unpleasant for those who aren't prepared. We had a demographic boost with the baby boomers coming of age, saving and investing, everything that did to housing and technology and everything. But the baby boomers are busting. They're going from producing to consuming, which is going to be a challenge. We had the demographic of benefit of globalization, specialization. We had tens of millions of women enter the workforce. And while some social conservatives are opposed to that, it did a good thing for the economy. We had declining real and nominal interest rates for Americans. We had really global hegemony. We were able to export worthless dollars and import all kinds of good stuff, steel, ships, computers, stuff like that. A fantastic trade. We were able to trade dreams for reality. That's over. So we need to come to grips with that. And the future, well, Robert Friedland said it best. The situation's hopeless, but it need not be serious. And I think it's important that people recognize what's coming and take steps to prepare. I think the 10 years ahead of us looks a lot like, not identical, but a lot like the decade of the 1970s. What happened then? Well, among other things, the US dollar in absolute terms lost 75% of its purchasing power over 10 years. Not relative to other currencies, they did worse. But in absolute terms, the US dollar lost 75% of its purchasing power. And I think the US dollar will lose 75% of its purchasing power in the next 10 years. The why, we've talked about before. The on-balance sheet liabilities of the US government exceed $36 trillion, and they're growing by $2 trillion a year, despite the big, beautiful bill, or perhaps because of the big, beautiful bill. And the off-balance sheet liabilities of the U.S. government, the net present values of entitlements, exceed $100 trillion. And that deficit goes by $2 trillion a year. Sorry for all the math, but it's important. What that means is that according to the IRS, the private net worth of Americans is $141 trillion. And we owe, just at the federal level, not state and local or individual, $130 trillion. Meaning that there's $11 trillion left over, except that we're increasing what we owe by $4 trillion a year on balance sheet and off balance sheet. This is not sustainable. And rather than deal with it, rather than have an honest default, go to the bondholders and say, too bad, so sad, out of money, you're not going to get paid. or go to the Social Security, Medicare and Medicaid and federal pension and military pension recipients and say, yeah, I know we promised you, but we lied. No money. That's not what we're going to do. Mm-hmm. What we're going to do is we're going to default on the installment plan. We're going to reduce the spending power of the US dollar. So we lower the actual obligation while not lowering the nominal obligation. It's precisely what we did in the decade of the 70s. Mm-hmm. So I think people need to understand that they need to rethink the amount of nominal dollars that'll be required to sustain their standard of living 10 years out. Younger people need to understand that Social Security will be there, except it won't. They're going to pay some old codger named Rick Rule, whatever it is they pay me now. I don't know if it's $4,000 a month, whatever it is. By the way, I give my Social Security checks to non-governmental organizations, to anti-government organizations. It amuses me to do that. But anyway, they're going to continue to give me my $4,000 a month or whatever they give me, but it's going to buy $1,000 worth of goods and services. Mm-hmm. So that's how they're going to default on the obligation. Exactly what they did in the decade of the 1970s. And so people need to prepare themselves for this. One way to prepare, I think, is if you remember back to the decade of the 1970s, the whole natural resource complex, because it's capital intensive, did well. Precious metals did particularly well, but that's not the whole answer, particularly for most people. It's important to note too, Tom, that by intelligent securities analysis, not momentum investing or hypergrowth investing, but through intelligent application of equity capital, Warren Buffett, during a period 1968 to 1982, a 14-year stagnant market in equities generated a 20% plus compound annual rate of return. But people need to apply themselves. People need to invest in more sensible value propositions and take a longer period of time. The wind is not in the sails of momentum-oriented speculation the same way it has been for 40 years. The animal spirits are going to be really tested because a lot of the animals, the market animals, are going to get taken out and get slaughtered. So it's important that people adjust themselves to the future that's coming, as opposed to adjust themselves to the past that they've experienced. Those that do this will do extremely well. The decade of the 70s was very, very, very kind to me until it was over. As a young man, I didn't understand that markets work. We've had that discussion on your show before. This too will end. At some point in time, we will solve the mess that we're in as a consequence of a slow motion devaluation, a slow motion default. When that's over, the lessons that we've learned in the next 10 years will change again, and you must be ready for it. Maybe I don't need to be. I'm already 72, but the people listening to the show. But I think it's important to note, to go back to the original quote of Robert Friedland, the situation is hopeless, but it need not be serious. Mm-hmm. You can panic or you can pounce. You can fail to survive or you can thrive. The choice is yours. It's just that you need to take action now. The big thinkers aren't going to do it for you. Trump's not going to do it for you. Carney's not going to do it for you. None of these folks are going to do it for you. You're going to do it for you.
Well, taking action is something that I actually recently spoke about at a conference as well. But Rick, what do you think are, let's say, the main pillars that we need to be cultivating within ourselves in order to recognize or to be able to capitalize on that value that can be created during these times?
I think a few things. I think you need to understand that the world that you're being taught exists doesn't. If you read a little book called Economics in One Lesson by Hazlitt, you can learn the way the economy works. Not the way the big thinkers wish it worked, but the way it actually works. And I think it's important to do that. I think it's important for people to, when they are investing, focus on the value of their investments, not just the cost. I notice in stock forums, everybody is paying attention to price and price momentum. Mm-hmm. But understanding the price is of no use if you don't have an opinion as to value. Money is made on the delta between price and value, or price and value created. And I see all sorts of discussions in discussion groups online about the price of XYZ security, and I don't see anybody paying any attention to the value or the value creation. Mm-hmm. Yesterday, at the Rule Classroom, I interviewed the CEO of Agnico Eagle, the most successful gold mining company on the planet. And I was struck, really, truly struck by his suggestion that they exist almost independently of the gold market. Their job is to discover gold or acquire gold cheaply, allocate capital well, be efficient builders and efficient operators. They said they live at the mercy of the gold price. In the last 18 months, the gold price is up really substantially, and their operating costs are up $2 per ounce produced. If you look at an industry where the gold price has gone up, but the operating costs have gone up dramatically, and the margins haven't gone up as much as the gold price, and then you look at the performance of Agnico Eagle, what you see is that their corporate culture is what contributes to their profitability. Mm-hmm. As an example, they're a hugely honorable organization. And they understand that if they look after their customers will look after, not their customers, pardon me, their employees. Mm-hmm. Their employees will look after their shareholders. The consequence of that is that their turnover is less than half of industry average. They don't have to retrain people because they keep the people they've already trained. Mm-hmm. And what he pointed out was that the safety culture exists there because they like each other. They want to be part of a team. They want everybody to come out of the hole safely. They don't want the supervisor to have to call a woman and tell her she's now a widow. And I think that lesson is something that we all need to emulate. We need to focus on our jobs about how we add value, not just make money. We need to, when we look at investments, worry not about the price so much as the value and the discrepancy between price and value. We need to confine ourselves to the extent we can to activities that we like doing so that we can outcompete pretenders and thrive in the space. And we need to understand that unlike the last 40 years, the wind is no longer in our sails, but it's not in anybody else's sails either. We have no control over the cards we're going to be dealt. We just have control over the way we play them. And we're going to need to be much more focused, much more disciplined. If we do that, and our competitors are distracted by the situation that surrounds them, ironically, it will be easier to outcompete because we'll still be competing when they're lying in fetal position in the corner, quitting because of the circumstance that surrounds them.
It's interesting to think about the value that a CEO and a culture can bring to a company. I listened to a podcast the other day on the Mike Rowe show, and he had interviewed I think he was like the 20-year CEO of the WD-40 company. And they had something like a 91%. Before COVID, they had a 91% satisfaction rate among employees, and it actually went up during COVID. And it's quite an interesting listen, and it really highlights the same idea of taking care of your employees, which ends up taking care of your shareholders as well. Go ahead.
And part of that, of course, is eliminating employees early on who don't buy into the culture.
Absolutely.
Sometimes you're doing somebody a favor, allowing that person to employ other employment opportunities mm-hmm. in cultures that they can adapt to more readily, or at least preventing them from polluting your culture. Mm-hmm. There's two parts to building a team. which is to say team building among those who want to be part of the team, and the elimination as soon as possible of those who don't want to be part of the team.
And I think that applies across not only building a team, but also building a portfolio too, right?
Sure.
Is eliminating and understanding the basis through which you're looking to eliminate the non-performers within your portfolio. And
Tom, that may be more important, because in building a portfolio, you're passive. You're not building a business. Somebody else has control of it. Mm-hmm. And you better choose that person well. We've talked before, I don't know if you recall, but in prior interviews, we've talked about Pareto's law. Mm-hmm. The fact that performance is not distributed equally among humankind. Even in any given task, the 80-20 rule, which suggests that 20% of the population generates 80% of the utility, is an important precept. But there's two other things to know. There's a good 20 that generates 80% of the utility, and there's a different 20 that generates 80% of the aggravation. So your first job is to identify the good 20 and hang out with them, mm-hmm. and avoid the bad 20, identify them, and avoid them like the plague. But what you learn is in a fairly large task, we talk about mining stocks. So let's say junior mining, mm-hmm. that if you take the good performing lip, that 20% that do 80, and you run it through the same performance dispersal curve, 20% of the 20 do 80% of the 80, which means that 4% of the population generates about 65% of the utility. Mm-hmm. I've learned in 50 years in the business, Tom, that if you run that 4% through the same performance dispersal curve, they conformably align again, which means that less than 1% of the management team generates well in excess of 40% of the utility in the sectors. So from an investment point of view, looking at track record, looking at corporate culture, and hanging out with the serial outperformers, in our business, the Robert Friedlands, the third generation of Lundins, the Ross Beatties, the Bob Quartermains, people like that, and ignoring the temptation to buy stories that are merely stories, that are run, and I apologize in advance for the term, but run by the lame, the halt, and the blind, is an important part of the discipline that allows you to perform well in your portfolio, which is by definition a more passive activity than running your own business.
Mm-hmm. Well, by definition, maybe it's just different, because I think it takes the same amount of work to understand that sector, understand or amount of being deliberate about building those skills to understand and then exerting the discipline that you're talking.
What I guess I meant is that in my own businesses, the Rural Media, the Rural Classroom, the conference business, Battle Bank, those are small enough businesses that I can identify for myself people who won't be part of the team, mm-hmm. and I can thank and excuse them. I can identify people in the team that I can mentor to increase their productivity, and I can do that. When I buy a stock, I've assigned that process to the CEO. It becomes more passive. I have less control over it. Yeah. So I have to select the CEO because I have no say in the employee line. Whereas, as you know, in the conference business or in my media and education business, if there's an underperformer, we allow that person to pursue opportunities in organizations where they might thrive. Mm-hmm.
Rick, I want to go back to something that you had kind of touched on earlier, and that's this idea of that lost decade, let's say, in the stock market after 1970. You know, of course, all of our listeners will understand that we came off of the gold standard in 1971. And we're looking at a possibility, let's say, of a lost decade now, as you mentioned. Do you think that we're going to have a particular type of catalyst, like a Bretton Woods, a new Bretton Woods, something like that, that kind of demarks or denotes this next decade?
There may be some psychotic break. There may be a change in government. but I'm much more interested in arithmetic than drama. We either, in the United States, have to have an actual default, which I think is highly unlikely, or we have a factual default. And I think it's the latter. The consequence of that, and I don't have anything like exact numbers, but if you look at $130 trillion in liabilities, federal government liabilities, in an economy that generates about 30 trillion a year in GDP, and if you factor in reasonable growth of GDP, if you could devalue the debts of the US government by 75%, by reducing the purchasing power of the currency by 75%, then the current level of government encumbrance is financeable. And that's what I think is going to happen. I don't think that we have the political will. I mean, I think we'll fiddle around with the edges of entitlements. The government is going to say to an old fat rich guy like me, you're going to pay tax, Social Security tax, on your whole income, not the first 160,000. And then they're going to say to me too, we're going to means test it. Despite the fact that you're paying on all your income, you ain't going to get any. I mean, that's going to happen. We're going to have a war against the rich. I get it. We're also going to change the age for vesting. When Social Security was instituted, it provided poverty level subsistence at age 65. And the average life expectancy of an American male was 66 years. So it provided poverty level existence for 1 year. Average life expectancy of an American male is something like 80 years now. The eligibility is down to 62, and there's a disability provision. They're going to have to change a lot of that stuff, but it's not enough. It's not enough. The big thinkers, and by the way, the beneficiaries, folks my age who say, I paid into it, I get it, I deserve it, So what if you paid into it? So what if you deserve it? You ain't going to get it. We need to understand that, and we need to prepare ourselves for it. The big thinkers in Congress say, tax the billionaires. That's the solution. Tax the billionaires. Again, let's do the math. The number is 130 trillion. It grows by 4 trillion a year. The net worth, aggregate net worth of all of America's billionaires is $6.7 trillion. If you stole all their money, not just increase their tax, you solve the problem for a year and a half. The arithmetic is not there. You solve it, if that's the right phrase, you bandage it by devaluing the purchasing power of the US dollar. By the way, it's important that your listeners note that this discussion isn't just theoretical. In the decade of the 1970s, when the US dollar lost 75% of its purchasing power, the gold price went up 30-fold. I'm not suggesting the gold price is going to go up 30-fold, but it stands to reason that the nominal price of gold might reflect the deterioration of the purchasing power of the US dollar. If that's true, gold goes up 4-fold. Let's say I'm wrong. Let's say that the purchasing power of the US dollar does decline by 75%, but gold only goes up 2-fold or 3-fold. It still provides you historic preservation of your savings. That's one thing that individuals can do. And I'm not suggesting, by the way, that everybody put 100% of their savings, their net worth, in gold. That's imprudent. I am saying that the market share of precious metals in the US economy relative to other savings and investment assets is 0.5%, down from a 4-decade mean of 2%. Given the probability of the economic circumstance in the next 10 years, I think allocations below 10% in precious metals and precious metals securities, for those who can afford it, is imprudent.
Rick, when we hear this, let's say that this plan of implementing tariffs to be able to fund the US government and fund, all of the liabilities that we now have and bring down deficits, how do you think that this is a reasonable way to actually fund the spending going forward? And what effects do these tariffs, if implemented, actually have on the economy?
We don't have a revenue problem.
Mhm.
We have a spending problem. Tariffs are taxes, and taxes suck. What we're doing is we're taking the money from people who have provided goods and services to earn it and giving it to an institution government that flushes it down the toilet. But make no mistake, tariffs are taxes. Mr. Trump is a good enough businessman not to actually believe that the Chinese are going to eat a 30% hit on stuff they sell to Walmart. The U.S. consumer is going to. That's who's going to. So what we're going to do, what he thinks we're going to do is we're going to take money out of our left pocket that we would otherwise have taken out of our right pocket and shift it to him. But I repeat, we do not have a revenue problem. The federal government depleted the coffers of U.S. taxpayers to the extent of $5 trillion last year. The problem isn't the $5 trillion. The problem is the fact that they spent $7 trillion. The answer is not revenue. The answer is voter expectation and expenditure.
Mm-hmm. And I think this idea that it's, red versus blue, our team spends less, the next team is going to spend more, that's, demonstrably false.
Correct. The fault has been on both sides of the aisle. Mm-hmm. I have a friend, you should interview him sometime, and if you want, I'll set it up for you, named David Stockman. Mm-hmm. David Stockman wrote a book called The Triumph of Politics, and that detailed the efforts of Ronald Reagan to reduce the size of government. You may recall, perhaps you're too young, in 1980 when Ronald Reagan was elected, by a landslide, by the way, not like the Trump plurality, but by a landslide. And his express goal was to reduce the size of government. He had an actual popular mandate to do that. Mm-hmm. And The Triumph of Politics was written by the director of the Office of Management and Budget, the bureau that was designated by Reagan as being the bureau that was responsible for reducing the size of the U.S. government. The book details the derailment of the Reagan Revolution within 6 months of his inauguration by Congress on both sides of the aisle. There is no surer guarantee that passes prologue than Mr. Trump's recent budget. A guy who's going to cut the size of government, but eliminates the debt ceiling and proposes the fourth largest structural deficit in U.S. history. This is not the stuff of smaller government. This is the stuff of different government. You'll remember the famous Mencken quote to the effect that elections are everywhere and always advanced auctions of stolen property.
That's a great way
and I would suggest that politicians on both sides of the aisle see their job as defending whoever they define as their constituency from the depredations of other senators and congressmen, while at the same time stealing as much as they possibly can from other people's constituents to the benefit of their own constituents. I believe it was Gore Vidal that described the process. He said, you understand politics by looking at the origin of the word. Poly, of course, from the Greek for many, and tick from the English colloquial for small blood-sucking insect. So if you look at the Democrats and the Republicans and their focused constituencies as shifting coalitions of ticks, each trying to suck the lifeblood out of America, you understand the process and the problem.
Well put, Rick, as always. It's again taking this longer term view is extremely important, especially when we're looking at this world of gold. And I think, again, taking that perspective and applying it to actually investing, I want to get your thoughts on how this, let's say, gold bull market is actually progressing. Gold has gained over 100% in the last 2 years. Silver is around 75%, and miners, as measured by the GDX, let's say, are up around 100% as well. So, I've heard many times as the bull market in precious metals matures, that the more speculative capital comes through that same type of progression from top down, from gold into silver, into miners, into, let's say, silver miners and the junior sector. So do you see this market as progressing in any type of a different way than any, let's say, of the previous bull markets? Is there anything different this time?
This is a textbook bull market, an absolute textbook bull market. For your listeners, visualize a bull market as a circus master's whip. The whip handle in the front of the whip is gold, physical bullion. Mm-hmm. It starts a bull market for two reasons. One, it's underpriced, it's out of favor, and there's a dead cat bounce. But secondly, the circumstances change so that people lose faith in the purchasing power of fiat-denominated instruments. We saw that begin in earnest in 2022. Mm-hmm. And the gold price ran. Now, I remember being on your show, Tom, and your listeners were concerned about the fact that gold was running, but gold stocks weren't going anywhere. That was easy to explain. Mm-hmm. There was a group of people, mostly foreign central banks, buying gold, and they don't buy gold stocks. So an asset class that had buyers went up, and an asset class that didn't. In 2023, while the gold price was going up, the inputs to produce gold were going up faster. So although the gold price increased, producers' margins didn't increase, with a couple exceptions. 2024 changed. The gold price kept going up, but the input inflation moderated. And so you began to see producers' margins exceed expectations. My expectations were bullish, and they were crushed. They were crushed. And when that happened, people began to look at the gold stocks not merely as vehicles for participating in the gold price, but as businesses themselves. Businesses that were, relative to the gold price and relative to the outlook for gold, at least my outlook for gold, cheap. So in addition to saving in gold, which I do, I began to invest more heavily in gold mining companies, following a classic pattern. What happens, and is happening right now, is that you see value discrepancies between the biggest and the best and the most liquid companies and the rest. The great big companies get the benefit of lots of passive flows from index buying, and the little guys don't. So the big guys get more valuable, and the little ones, relative at least, get less valuable. One of two things happens now, Tom. Either value arbitrageurs take some of the capital that they would otherwise allocate to the biggest and the best, and they come down the quality trail to get better relative valuation. Classic in a bull market. It's called value arbitrage. Or the big companies with a lower cost of capital take over the little companies with a higher cost of capital. Mm-hmm. But either way, market leadership begins to shift from the biggest of the best to the best of the rest. And over time, that progresses down to single asset producers, which are regarded as riskier, or developers, all the way to the penny dreadfuls, the exploration stocks. Somewhere in this continuum, when the generalist investor gets convinced because of price action and market momentum of the precious metals narrative, leadership switches to silver. I've never known why this occurs. I speculate that it's because of the lower unit price of silver. You know, somebody with a saver with $5,000 maybe doesn't want to buy gold, but is able to, buy units. I don't know why it is. I just know that it is. When that happens, market leadership transfers from gold to silver. Silver moves much further and much faster. I don't think we're there yet, by the way. I think what we're seeing right now may be a fake out as opposed to a breakout in silver, because I don't see broad-based public participation in precious metals markets yet, and that's usually the precondition for the silver breakout. I hope I'm wrong, but I don't know that I am. But at any rate, the bull market that we're in is following a textbook progression from bullion on down the quality trail.
Rick, as we think about that progression from, let's say, gold to silver, I've spoken even in the last week here to a couple bullion dealers, and they've expressed that exact sentiment that you just did about the idea that there's no real public participation at this point. So how does, let's say, the health of the average investor within this economy come into that calculus of having that shift and having that capital come into the precious metals sector?
Just takes time. Things are progressing nicely. This now is depending on how you define bull markets, my fourth bull market. Mm-hmm. If I would say that most investors had they have two overriding flaws. Most investors are lazy, which is a bad thing. But most of them, I shouldn't say most of them, many that have the right investing strategy have the wrong investing tactic. Mm-hmm. If you believe in a decade-long precious metals bull market, which I do, but you invest having trauma holding over a long weekend, you're setting yourself up to fail. I don't know if silver is going to break out this year, next year, or the year after. What I do know is that in each prior bull market, when it broke out so conclusively that the fact that I was 2 or 3 years early didn't matter. It really, truly didn't matter. And for those who can afford the risk of the silver equities, not silver, the silver equities, by the way, not the guys that don't have any silver, the silver animals, as I call them. People whose exposure to silver is confined to the fact that silver is mentioned on the heading of the share certificate, but they don't have any silver. Rather than that, if you put together a portfolio of, say, 5 silver juniors, you will be astonished at the performance of that portfolio over time. You may be terrified about the volatility that you experience waiting for that to occur. And you may get bored. It may be that you hold silver stocks and uranium runs, and your mate at the gym or your mate at the bar made a double, and you lost 5%. That doesn't matter. It's just noise. I remember in the decade of the 70s, one little penny dreadful, Coeur d'Alene, ran from 10 cents to $65. Sadly, Tom, I was too young, too dumb, too broke to take advantage of that. Mm-hmm. But by the time the bull market of the early 90s happened, silver had fallen back to $4 from $50. Everybody hated silver. I mean, really hated silver. You would have thought silver was a 4-letter word, I helped finance and put together 2 little companies, Pan American Silver and Silver Standard. They went from 50 cents and 72 cents, respectively, in 1990 to over $40 in 1996. If you get a move from less than $1 to over $40 in 5 or 6 years, the fact that you had to wait a couple of years becomes irrelevant. Mm-hmm. The other great lesson is in the 6 years that those companies made 40-fold progressions, 2 or 3 times in that 5 or 6 year period of time, the share prices declined by 50% or more. So you have to be patient, and you have to be persistent, and you have to be tenacious. If you have a sense of what the value of the investment is, and what the value will likely be if the set of circumstances that you believe will occur does occur, then the price matters to you less. if you don't, natural and normal perturbations will shake you out of what was otherwise a very good investment.
Mhm.
Those are really important lessons, particularly in the silver space, because it's so volatile. Tom, I probably have now 3% of my portfolio in the silver stocks. The silver stocks, loosely defined, that includes Pan American, which is more now a gold producer than a silver producer. It wouldn't surprise me to see that 3% of my portfolio become 20% of my portfolio organically without me adding any capital to it. I'm not saying it's going to, but it wouldn't surprise me to see that happen. It also wouldn't surprise me to see the price of that portfolio in the aggregate fall by 25 or 30% at some point in time in the next 5 years, which doesn't bother me a bit. And your listeners need to begin, if they're going to speculate, if they're going to look for 5-fold returns or 10-fold returns or 15-fold returns, they're going to have to accept time, and they're going to have to accept volatility, and they're going to have to accept real risk.
Well, Rick, this is something that I think is of extreme importance, is to understand the long time arc of these things and the importance of patience, right?
Right.
And this is something, that I think is worth repeating, is that exact idea of understanding the value proposition and then being able to shut off the daily noise and look past all of these things. And again, that's something that I appreciate being able to go over with you.
Tom, I think you have to anticipate them. You have to count on them.
Exactly.
Here's an example. In the decade of the 70s, at the beginning of the decade, gold was at $35 an ounce, right? As people had really begun experiencing inflation from 1967 on. But until the compound effects of inflation on their paychecks were felt, they didn't begin to take action. The gold bull market began fairly slowly, but in the period 1970 to late 1974, 1975, the gold price ran, mostly in the latter years, from $35 to $200 an ounce. That 6-fold move in the gold price validated a lot of narrative. People began to be attracted to gold, not when it was going to move, but after it had moved.
Mm-hmm.
In 1975, the population was concerned enough about inflation that Fed and the Congress raised the interest rates. When they did that, the gold price fell from $200 an ounce to $100 an ounce. Concurrently with the bond market falling, the housing market falling, and an already anemic equities market falling. Congress and the Fed lost their nerve at the end of 1975, began to print in earnest, brought the interest rate down, and the gold price moved from a low of $100 or so to $850. The point of all this is that in the middle of the greatest bull market that gold has ever seen, the gold price fell by 50%, with the bull market still being intact. Mm-hmm. And when I say that people have to anticipate this, if I believe, as I do, that there's a probability rather than a possibility that the gold price in nominal terms goes up 4-fold in the next 10 years. That's what I believe. I'm not saying it's going to happen, but that's what I believe. Mm-hmm. It wouldn't surprise me at all to see the gold price go from $3,000 to $6,500 and then fall back to $3,000. Mm-hmm. That wouldn't surprise me at all. I anticipate it. And I think that people need to look at their portfolio and anticipate risk, anticipate volatility. I'm not sure, as an example, that we're going to have a confidence-inspired liquidity event like 2008. But despite the fact that I'm not sure it's going to happen, I'm preparing for it.
You remain open to the possibility of it.
If it doesn't happen, then that just means that I maintain too much cash in my portfolio. That's all it means. Mm-hmm. I realize that maintaining cash means that that portion of my portfolio, which is in liquidity, is depriving me of purchasing power through inflation. I get that. I get that getting paid 4.3% in a currency where the purchasing power is declining by 7.5 means that my purchasing power is declining by 3% compounded.
Mhm.
To me, that decline in my purchasing power is an option payment on having liquidity available to me in a liquidity-driven squeeze like 2008. If the liquidity-driven squeeze doesn't occur, what it means is that I will lose 3% compounded of my purchasing power on 25 or 30% of my portfolio. I can live with that.
So, Rick, at this point in the gold bull market, are you looking at M&A targets, takeout targets? Have you moved down that ladder, or have you already positioned for this?
Some of both.
Mhm.
I want to say that moving down, what I'm actually doing is adding capital to the portfolio. My Franco-Nevada, my Wheaton Precious, and my Agnico Eagle are not for sale. So I'm not going to sell, pay capital gains tax, and buy a lower quality company with money I have in higher quality companies.
Mhm.
Just very recently, maybe 6 months ago, the uranium juniors were stupidly oversold.
Mhm.
And so I added to my core position a trading position. They're no longer stupidly oversold, so I sold them. But not all of them. I sold about 20% of my portfolio. I sold my trading position.
Mhm.
And I'm moving that capital into what I consider to be value discrepancies down the quality chain in the golds.
Really? So you're not reinvesting, let's say, uranium sector funds within the uranium sector after that market has taken a bit of a breather?
I own a lot of uranium, and I mean a lot. And the oversold nature of the uranium trade 6 months ago, I didn't have to add to a core position because my core position is mammoth.
Mhm.
But I knew that this period of hate would subside. Let me digress, Tom. When I used to run a retail brokerage firm, one of the ways that I would measure sentiment was to look at the priority of buy tickets over sell tickets or vice versa. And if 80% of the tickets written during the day were buy tickets, I would make myself sell something. And if 80% of the tickets were sell tickets, I would make myself buy something.
Mhm.
So in the uranium trade 5 months ago, you had people who had uranium as part of their internet handle, their name, capitulating,
Mhm.
saying, I wish I never learned about this stuff. Hate doesn't get better than that. And so I had to add a trading position. Now that you have people re-adding uranium to part of their internet handle, that means the hate has subsided. The reason that I bought those positions was to trade them when the hate subsided. So my reason to own the stocks went away. So the stocks went away.
Mhm.
And I'm redeploying the money into the sector that I think will gain public appreciation the fastest, where I see the broadest value discrepancies. People are already watching the gold market. We don't have to wait for that to occur.
Mhm.
Look at the performance that we've seen in the shares of Lundin Gold. They deserve it. They've been just spectacular performers at a corporate level. The share price appreciation that we've seen in Agnico Eagle, in Alamos, this has all been deserved. But there's eyes on the subject. The corporate performance has been mirrored by share price performance. This is classical value arbitrage coming up in an underlying bull market. The serial issuers who are using the capital well, I'm thinking G Mining, have also done an extraordinary job because although they've had to issue shares, put more shares on the market, they've employed the capital in a way that has meant that the additional share issuances, rather than being dilutive, has been accretive. They've applied this capital to businesses where they're generating a 50% return on capital employed. This is the part of the bull market that isn't too hot, it isn't too cold, it's just right.
Well, Rick, as we talk about the idea of value here, one thing that you and I have touched on in the past is the oil and gas producers. You've told me before that the cure for low prices is low prices and vice versa. And I just want to get your take right now on the oil price being so low and what that has really done to the oil and gas producers, especially ones with a higher cost of productions like the gas producers in the Bakken.
First of all, I'm not an economist, right?
Mm-hmm.
But my belief is that we are likely in a recession. And a recession in the near term will continue to put pressure on energy prices because energy is an economically sensitive sector. The cure is already in place for that, but it may take 18 months. Mm-hmm. The cure is that we're seeing in basins like the Permian and the Bakken a real slowdown in drilling. We're also seeing higher cost of capital. The prime rate has gone up, and the spread between prime and subprime junk debt and the availability of bank credit has moved against the oil producers at the same time that their equity prices have declined. So their costs of capital are going up at the same time that their product price is going down. Mm-hmm. And we're seeing a real reduction in drilling, which means that the temporary overproduction that we saw, particularly in the U.S. natural gas market, is coming to a close. And you'll recall, Tom, we talked 2 years ago about the fact that the cure for low prices was low prices. What we've seen in the United States is a tremendous increase in natural gas utilization. The onshoring is an example of the German petrochemical industry from Germany, where they can't get gas, to the U.S. Gulf Coast, where they can. Mm-hmm. LNG facilities. This is a wonderful arbitrage that's coming up. The more interesting arbitrage is in Canada. As cheap as the U.S. oil and gas industry is, the Canadian oil and gas industry is cheaper. The Western Canadian Sedimentary Basin relative to the Permian is way under-drilled. Canada has the infrastructure, not complete, but good infrastructure for gathering and transmission, wonderful human resources, a great regulatory climate. It has everything in place except the top. It had a prime minister for 10 years who was anti-energy. I would argue that they have a prime minister at the top who has said that he is going to put climate at the center of every financial transaction. That suggests he's anti-energy too. Mm-hmm. He suspended the carbon tax, not because he doesn't agree with the carbon tax, but because he wanted to get elected. Polls showed him that 81% of Canadians opposed it. Mm-hmm. It may be, he's a very smart guy. It may be that he realizes that the way he wants to spend money for the next 10 years in Canada isn't financeable without revenues from oil and gas, because he is jawboning something about Canada being an energy superpower, which doesn't seem to be, at least on the face of it, anti-energy. Now, he is a politician. One could argue that you can tell he's lying when his lips are moving. But it may be that reality forces him to be less obstructive to the oil patch. And if that happens, notice I said if, not when, if that happens, the high quality Canadian oil and gas producers, particularly the gas producers, are gonna rip, mm-hmm. really, truly rip. The net present value of proved undeveloped locations in the Western Canadian Sedimentary Basin relative to the Permian Basin, there are so many more high quality PUDs in Canada than there are in the US, that the Canadian industry has the ability, if unshackled, to generate the same type of growth that we saw over the last 10 or 15 years in the Permian, which is mind-boggling if you think about the fact that the most over-drilled strata on the face of the earth doubled production. It's a wonderful prospect to behold.
Mm-hmm. Rick, you've created a lot of value for investors and people that want to learn within this space over the years. What are you continuing to work on at the moment here?
I'm really doing three things. First, through Rural Investment Media, I grade for free people's stock portfolios, natural resource stock portfolios, I should say. Go to ruralinvestmentmedia.com, list your natural resource stocks, and I'll grade them 1 to 10. Use that at the Rural Classroom. The Rural Classroom, we have over 200 hours of instructional programming, including 11 and a half hours on how to invest. Use that to understand how to do rudimentary securities analysis yourself. Every year, I put on 4 boot camps online, deep dives into one specific topic about investing. We've done uranium, we've done silver, we've done prospect generators, we've done royalty and streaming. These are 8-hour-long intensive sessions online. And once a year, we put on an investment conference. We've done it for 30 years. We're doing it July 7th through 11 this year in Boca Raton, Florida. It's called the Rural Natural Resources Investment Symposium. If you can't come to Boca, that's okay. 2,000 people from over 30 countries will join the symposium online. Over 4 days, we give you 55 hours of programming, which is more than you can absorb, but we have access to the recordings for a year. And by the way, if you attend the symposium, either in person or online, and you don't think that I gave you your money's worth, I'll give you your money back. It's the only investment symposium I know in the world with an unconditional money-back guarantee. Nobody else has the confidence to do that, but we do. Because we've done it for 30 years. We know how to do it. So that's the Natural Resources Investment Symposium, July 7th through 11 in Boca Raton. By the way, I've interviewed every public company exhibitor. They're at the Rural Classroom and at the Rural Investment Media YouTube channel. So you can watch my interviews with over 50 public company issuers before the conference. Frankly, whether you intend to attend the conference or not. It's very, very, very useful content. But particularly if you're going to attend the conference, being familiar with what you want to see there before you get there allows you to utilize your time much more effectively. Mm-hmm. So that's really what I'm about. As you know, Tom, I failed retirement completely. I'm having a ball doing this, and it's working out well for everyone.
And just as a side note, I had the privilege of attending the conference last year, and the amount of value and content that was there was absolutely incredible. So, as you said, the idea that you can absorb even a tenth of the information during the actual conference is extremely hard to do. And it is great to be able to have access to it afterwards.
Tom, I put on the conference and I had to play the tapes twice. So that'll tell you what a serious student has to do.
Mm-hmm. Rick, earlier you mentioned saving in gold. How does that compare to the idea of how you've structured Battle Bank?
Well, Battle Bank is part of that, frankly. Banking is a very good business. It's a business I understand. I've been part of 7 banks. This is my 7th, 6 banks prior to this. Banking really involves finding a market niche and serving the hell out of it. One of my market niches is people who own physical gold and silver. And there's no bank in the United States or Canada that has a retail lending product secured by gold, silver, platinum, and palladium. What does that do for me? Well, I happen to believe they're great forms of collateral. Mm-hmm. I know the people who save in gold and silver, and they're good people. They're prudent, and they pay back their loans. And part of banking is customer acquisition cost. How do you add customers? While we've been going through the regulatory morass forming Battle Bank, I've been talking about it on channels like this, and 17,000 people have applied to be on our waiting list. 12,000 of those 17,000 have told us what products that we have, either deposit products or lending products, that they want to access. 6,000 people have told us that when Battle Bank opens, they want to post physical collateral, gold and silver, with us and use it to secure a credit line. Perhaps they want to make a down payment on a rental property. Perhaps they want to buy more physical gold and silver. Whatever. There's a lot of people in the world that have a lot of money tied up in physical gold and silver and want to have that money tied up, but they want to access that capital simultaneously. And Battle Bank exists to do just that.
Excellent. Well, Rick, is there anything that you'd like to leave our listeners with to think about before we wrap up here to, really consider in this longer term perspective that we've really tried to highlight here today?
Let's return to Robert Friedland's quote. The situation is hopeless, but it's not serious, at least for you. If you prepare yourself, you will do well in this circumstance. Unfortunately, unlike the last 40 years, if you don't prepare yourself, you won't do well. You'll do very, very, very poorly. So the choice is yours. Educate yourself, act prudently, save, invest, work on your own personal reputation so that other people will do business with you, and pay attention to doing business with people that have good reputations. This is going to be a lot of fun for those people who make it fun. It's going to be very, very unpleasant, I'm afraid, for those who don't. And I hope that your listeners are part of that group of society for whom this is fun.
Well said, Rick. It's always a pleasure to spend some time with you and get a little bit of your wisdom here. Of course, for anybody that's looking for more of Rick's content, that's all available at ruleinvestmentmedia.com, battlebank.com, and
rulesymposium.com.
Exactly. And of course, excellent Twitter follow as well at RealRickRule. Rick, it's always a pleasure, sir. Thank you so much for your time today.
My pleasure, Tom. Thanks for the opportunity. And I hope we see you either live or via live stream at our symposium.
Absolutely. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.